Today we're going to talk about Huya stock and if it's a buy or a sell. I've got a lot of questions about Huya recently and I wasn't going to talk about this company just because I think I've covered it about 10 times over the last 3 months with the combination of YouTube and Patreon. But I thought, you know what, I will go through it one more time because sometimes what I feel it's good to do is that when I go down 20-30% on a long-term investment, which in the short term can happen quite often, this one's actually down a little bit more than that. This one's actually down, I think I've been down about 40% on this one. When I go down in the short term in a position like this, sometimes what I like to do is just like step back and kind of re-look into the company and think, okay, has anything changed for this company? Should I be a little bit worried, or is this an opportunity now where you look at an investment and go, okay, I'm down 40% on this company, but nothing's really changed, and because it's now down 40%, is the money that I can make on this company even higher now because the stock is lower and where I think the company is going is roughly the same, then I can make more money on this company? Or has something changed and you know what, or maybe the first time round I looked into this company and there was something I missed and maybe it was a company that I should have avoided. And sometimes when them sort of things happen in the short term, I like to just reassess it, go back into it and see if it's a buy or it's maybe a mistake. So I'm going to do that today. I wasn't going to do it, but I thought, you know what, after the recent Q2, it would actually be a very good opportunity to re-look into this. So I am going to do that today. And what I'm going to do is I'm going to go through the share price, market cap, valuation, profit revenue, balance sheet, TAM, ownership, earnings, and also the market share as well. Earnings being the recent Q2 as well. So we'll take a look at that. Now, if you do want to start investing, there's some links to some brokers in the description like Free Trade and Stake. You join through there, you get a free share. At the moment, the free share you get from Free Trade is valued between £10 to £200. And if you join through Stake, they're doing a special offer through August, where if you join through there you get 2 free shares this month as well, so do go check them out. But let's take a look at Huya. So if you don't know what Huya is, it is a live stream platform which mostly focuses on games and also the growth in esports in China, which obviously China is one of the biggest countries and economies that are growing out there, especially with the rising middle classes leading to more people doing live streaming and playing games as well. So this is the platform if you've never been on it. It's actually a pretty good platform. I've actually previously watched a couple of games on here just for market research, and I've actually spent a bit longer on it than what I actually thought. You kind of get into a few of these games. Now, if we look into the company and how it's been going, as I said earlier, I'm kind of redoing this from a fresh kind of mindset and thinking, okay, is there something kind of going on in this company that I should be worried about? Now, if you look at the company, it IPO'd in 2018. It came onto the stock market at $19. It shot up to $46, and since then it's fallen down a massive amount. So you're looking at this going, okay, over a 3-year period the company is valued less than what it has done in 3 years period. So right from here you're kind of thinking, okay, this company, there's something wrong with this company. It's not performing on either revenue or earnings, because if a company is growing revenue and profit in the course of a 3-year period, you'd expect it to be valued more than what it was previously. So that's the first thing you're kind of thinking, okay, but we're going to look into earnings and revenue in a little bit here. Now, it has been a little bit choppy, but the little thing that is really surprising here is that only in February 2021, so we're talking only, about 6 months ago here, the company was actually valued at $34. So it does seem like this can be a very volatile company. And once again, you're thinking, okay, if this company was at $34 in February, and then from February it's fallen down 71%, you're thinking, okay, something's gone wrong with this company in the 6 months period to be down and lose that much value. Now, we will look at financials in a second to see if there's anything wrong with the financials. But going into just what we can see here, we can see there is around about the 52-week low, and we can see here it trades at a P ratio of 17. Now, straight away, if I'm seeing that, I'm thinking, okay, we've got a profitable company here, which is good. And also the big thing as well is a 17P ratio. So you think about, what does the market trade at? Normally, the market trades at 20. So if you're thinking what trades at 20, you're thinking the companies that trade at 20 are the companies that are kind of like very mature companies, that are profitable companies that grow probably profit and revenue around about 3-4% a year. So you're thinking, okay, it's undervalued at 20, and I'm kind of thinking straight away, if it's 17, then I'm expecting something like a 3-4% revenue growth and profit growth company here. So that's the first thing that I'm thinking at that sort of valuation. Now, just flicking onto Y charts, and yes, I am still freeloading Y charts. I just can't get around to paying $400 a month for it. It's crazy, but it's a great platform. So just ignore this little message here. But just going on to like the valuation side of it, you can see here price to sales ratio. Now, this is quite shocking because you see here the company came on just about 3 price to sales ratio, shot up to around about a 13 price to sales ratio, and you can see here historically it's traded around the 4 price to sales ratio, and at the moment it's dropped down to a 1 price to sales ratio. So that's a massive discount from what the company normally trades at. It's normally 4 times higher than where it is right now. P ratio, flick onto a P ratio, and this is scary once again. We've got a company here that traded at 120 P ratio, and once again kind of stuck around about the 40 P ratio, I guess, and then at the moment it's down at 17 P ratio. So the company has halved its valuation over the last year. So once again, I'm looking at all these metrics. The company is just looking at cheapest it's ever been, and I'm thinking this is really cheap, and potentially there's something going wrong with this company here. And if we look at the market cap, this company has touched about an 8 billion valuation before, and once again we're normally talking about a company that's traded around about a 5 billion valuation. So only recently it's gone from about a 5 billion valuation down to a 2 billion valuation. So yeah, same again, I'm looking, thinking this company is probably, the revenue shrinking on it, the profit shrinking on it. Something's gone wrong with this company to be trading down at this valuation. So now we look at what's going on financially. I'm expecting revenue declining, profit declining, or very slow growth here. So we go on the company here, and on 2016 they were doing 796 million. Now this isn't in dollars, just so anyone that kind of thinks, but that's not in dollars, you do have to convert it, just in case you don't know that. But you can see here 796 million, losing money 625 million. Now fast forward, we're seeing good revenue growth, and we are getting towards where we are roughly about now. And you can see here the company is now doing 11 billion. So over the course of the last 5 years, this company has increased revenue by a huge amount. It's also very important to say as well, this company has gone from losing a lot of money to being a very profitable company as well, which is really good. So from a point of view of, okay, how is the company performing even over a course of a year period, which has been a strong year because of the whole CV situation. We've got to remember as well that might mean growth will be a little bit slower this year, but you look at the revenue growth is very, very impressive, and you look at the profit growth as well, the profit as well has nearly doubled as well. So you look at this company and you think, okay, the revenue is performing amazing, this is a very big growth company, and you look at the profit that's coming in and you're thinking, wow, this profit is this company is now turning into a bit of a profit company. So going back to the valuation here, and we talk about the company is valued at a 17p ratio. It's at a 52-week low. The company is valued on its sales cheapest that it's ever been. You're looking at the P ratio, cheapest it's ever been. You're looking at the market cap, cheapest it's ever been. And you look at the financials, there's a big disconnect going on here. There's a big disconnect because these financials are impressive and growing year after year, and the company should trade higher. The company should not be going down in value if the company is growing and putting in that profit and revenue growth. So straight away you can see here there's nothing wrong with the company. The company is performing fantastic. There's a disconnect between the share price and the financial performance of this company. What I'd go is just do a quick check onto the financial health of the company. I look at the financial health. Okay, so this company is getting healthier as the years have gone on. There's no debt on there. It's very good. Okay, and then you look at the assets to liabilities. Wow, look at this. Assets to liabilities, very, very good on that side of the company as well. Go on to balance sheet, no debt on there. Sitting on 10.7 billion in cash. Now, if I convert that very quickly, that's around about 1.5 billion in cash if we went through dollars. And I just have a quick look at the share price. Okay, the company is valued at 2.3 billion. I look at the health of the company, and the health of the company is 1.5 billion. So at the moment I look at that and think, okay, that's actually crazy, because I'm looking and thinking here, the company's valued at 2.3 billion, but it's got 1.5 billion in cash. So I'm thinking here that the company has half of its value in cash. So basically I'm looking at this and thinking, okay, if someone came in and bought this company, if everyone wants to buy the whole company, they're paying 2.3 billion for this company, but straight away you would get over half of your company back in cash because it's on the balance sheet. So basically you are buying this company for 700 million. Okay, and if I have a look very quickly at what the company was doing, the company is doing already just short of nearly 100 million a year in profit. So you are literally picking up a profitable company here for a very, very cheap price if you were to buy out this company. So the valuation is crazy and the balance sheet is so good, and the revenue and profit growth is so good. What I want to see now is the market share. How is this company doing in the whole market share of the side of it? So I can see here, Huya and Douyu have a market share of over 40 and 30%. So at the moment, Huya has the 40% of the market at the moment, and the second competitor is a company called Douyu, which owns 30%. So these two look like the major players at the moment because between them they have 70% of the market. But at the moment, Huya is the better company, having more of the market share and growing quicker than its rival. So that's very positive that I'm buying the market leader, and also the market leader is growing a lot quicker than the second place company as well. So that's very good, market leader, and as well that they're growing a lot faster than them as well. So that's a very positive sign when I'm investing into a company. So next up, the TAM. How quick is this area growing? So if we look here, the Chinese esport market generated US 385 million and was estimated to grow at a compound rate of 17% until 2023. So this is a high growth area that I'm going into. 17% compound rate until 2023 is really good. And going on previously, you can see here the esports players, China nearly doubled the size between 2017 to 20, reaching 480 million in 2020 from 250 million just 3 years ago. Now, obviously, it goes on to say that there was a little bit of a spike user growth because of the CV, so we have to take into consideration there might be a little bit of a slowdown in the next kind of 12 months, but past the 12 months, it's still going to carry on growing. So we're in a very high growth area right now. And just a couple little charts here, you can see the revenue of gaming streaming in China, and you can see the growth here that it's previously had. So now I'm looking at what is the most popular games at the moment, and this is from Douyu. So you can see here, Honor of the Kings, Tencent, Player Unknown, Battleground, PUBG. Their publisher is PUBG, but I'm looking through this list here, and what I'm seeing is, I'm seeing a lot of Tencent. So I'm looking here and thinking, okay, most of the most popular games are developed by a company called Tencent. Now there's a few other makers in here for sure, but definitely a big part of this is Tencent that owns a lot of these companies. So I'm thinking, well, if they kind of want to make money off Tencent's games being on the platform, the esports tournaments and exclusive rights to the esports tournaments, then there needs to be a good relationship between Huya and Tencent. So I look at the company here and I look at the ownership here, and the thing that blows my mind is, who is the biggest holder of Huya? Tencent at 47%. So I'm thinking, okay, the people that you rely on to get most of your content from is a big shareholder in your company with 47%. So I'm thinking, okay, there's basically a thing here where Tencent can give exclusive rights to Huya, and there's a great partnership here. So you kind of have a big monopoly on this space because you are owned by the company that makes the games. So there's no risk of them actually turning around and going, oh, you can't use our games anymore, because it won't be in their interest. So that's a very positive sign here. So I thought, well, let's have a look what's going on with the recent earnings. So recent earnings beat by 2 cents, beats on revenue, so very good beat here. 10% growth, still pretty good. Obviously, it looks like there's a little bit of a slowdown going on because they've got very hard year-over-year comparisons to beat, but still, I'm pretty happy with the earnings that have gone in here. You looked here, pretty much went on to say, revenue growth. Users a little bit flat, fair enough. It's hard numbers to beat, so I'm not too bothered on that one. There's a lot of platforms you've seen like this that are struggling to keep up a lot of their user growth. So yeah, that's absolutely fine. And then look here and I see, okay, one of their smaller income streams at the moment is advertising. So I look at advertising and other revenue. So at the moment, this could be one of those things that you look at in a company, and I was talking about this on Patreon, is that you look at a company and think, okay, this is the income stream, but what other income streams are going to help in the next few years? Advertising and other revenues increased by 189%, which is crazy. And you look here, this is making up 59 million US dollars. So if we look at the revenue at the moment, which came in at 458 million, you can see here this is starting to make a bigger part of the company up. So if you think at the moment the company is doing 458 million there, and this is making up 59 million, but it's growing at 189%. Okay, so if you think about next year, if they can grow that at 100%, for example, then that's now starting to make up 25% of the revenue. If they grow that again at 100% next year, then it's starting to make up half the revenue. And this is then like another income stream that's starting to build inside the company, and people don't realize until they go, oh, look at how much that is. Now, I'm not saying it is going to grow at them exact rates, but it's spotting these little things that are going to start adding into a lot of the money further down the line. Advertising was never a big part of Huya, and now it's starting to come in, and that's a big thing to kind of like spot really quickly. So very quickly, after looking through the earnings, go listen to the conference call, go through the transcript here, and I look here and think, oh, that's very good. We've got some more positive news about Tencent. And you can see here that even though monthly active users were decreasing, you can see here that there's actually a lot of monthly active users that don't use the platform because they don't count them because they come through Tencent's platform, which is QQ. But if they were to count them, they would actually be around 23 million, doubling year over year. So that's very interesting that they actually have more users than they actually report, and them users are actually growing because of their collaboration with Tencent. So that's a very good thing. So that little worry that I had, maybe it was slowing down a little bit, it's not too bad because there's actually quite a few users coming onto the platform through Tencent. And then once again, I see some more information about Tencent, thinking, okay, we need these guys for this company to do well. And you can see here they're expecting to hopefully to still further deepen their cooperation with Tencent. So once again, a very positive statement here in this earnings report. And then one little last gem in this earnings report here was moving onto our overseas business. So this company is obviously based in China, where a lot of the revenue comes from, but to see that they're moving overseas, what did I say earlier? You look at advertising, new income stream coming in, you will now have potentially moving outside of China. That's a very interesting move. So moving on to our overseas business, in June, the overseas monthly active users picked up to close to 27 million. And also our overseas revenues increased by approximately 200% year over year, which is crazy. That's a massive growth. So you're seeing here, okay, the company's moving outside of China now, and their revenues outside of China is growing at 200%. So once again, you start thinking, well, what happens if next year this still grows at a very good rate? How much does that start contributing? How long do people start realizing, oh, this is another little income stream building up in Huya here, and that's another positive sign of another little income stream that's building up inside this company. And last thing I'm going to leave you on is this. Twitch, the US version of Huya, on August the 25th, 2014, it was bought for 970 million. Do you know what Amazon paid for Twitch? 70 times sales. 70 times sales. Now I'm just going to flick back to the early thing here of our price sales ratio. So just flicking back to here, 70 times sales, and I know this was a few years ago and there probably been a bit of a hyper growth, but 70 times sales. Bit crazy, isn't it? So if I didn't actually own Huya right now, after going through all that information, I would definitely be interested in this company, and there's nothing really there that has worried me that I would be spooked about buying into this company. Now, you'd be thinking there must be a reason for the share price drop, and I would agree there is a few reasons for the share price drop. At the moment, there was the merger, which then kind of fell apart, and I think that might have spooked investors, I guess. A lot of uncertainty was there. Well, good thing to say though is that people question the cash pile and go, is that actually legit? And it must be legit because we were going to get paid a dividend if that merger was to go through. People also ask about the company, about the cash pile and what's going on in the cash pile. Can they do buybacks? Potentially, yes, they could do buybacks on that company, but historically, a lot of Chinese companies are very slow to do buybacks. Alibaba is a prime example, so I won't worry too much about that. It would be good, but it's not a bad management for going, oh, you've got all that cash, you're not doing a buyback. If they think their cash is better somewhere else, if they're looking to maybe acquire a company down the line, that would be totally fine. So calling management out because they're not doing a buyback, sure, it might be good for us to have a buyback, but it's not the end of the world. And I guess the other thing that has spooked the company in the short term is a lot of this negativity that is coming out with China at the moment. Personally, it's just one of those things. I've seen it all before. Eventually, a lot of it will blow over. But when I look at the company is performing absolutely amazing. And it kind of went to this point of view is, do I buy or sell Huya? If I wasn't in the company, I would personally be looking as this is a buy right now, because I would be thinking it has a lot of upside. As someone that is invested into Huya, there's no chance I can sell at these sort of prices. It's historically so cheap. The company's performing amazing financially, so there's no worry here for me. I'm not panicking at all, and it's just one of those things where if you're a long-term investment, anything can happen in the short term. and it has gone down in the short term. But am I panicked? No, because it would be stupid for me to take a big massive loss here, because the company is performing absolutely fantastic. And in fact, after even doing this video, it kind of confirms how bullish I am on this company. And it's just one of those where I'm still going to carry on just buying a little bit now and then, and get that average down, and hopefully potentially make more money. Like I said earlier, you know, when I bought this company originally, my price target was for it to go to $40. I still think it'll go to $40. The big thing now is that what I have is that I had previously an average at $21, and I had about 100% upside. Now that my average is going down, I think it's 17 at the moment, and it might go down even lower. The more money I'll make on it going to $40 is even more, which is a scary thought. And the thing as well is, like, if I wanted to make 100% return on this company, it doesn't even have to be $40 right now. I could sell out at $34 and I'd make 100% return as well. So that's the big thing that's the big advantage I have right now. And the big thing it just kind of leads to now is just like unfortunately, you know, sometimes it's just patience. You know, a lot of big reason why people don't make money in the stock market, and people will give up on this in the stock market, or even give up on a company like this, is just because they don't have the patience. And that's what you know, one of my favorite investors that I learned off when I started investing, which was Warren Buffett. The big thing, you know, he always get asks is, and I think it was Jeff Bezos who asked him, is like, why don't people just do this, you know, buy and hold great companies? Because people don't have the patience. No one wants to get rich slowly. And this is a prime example. And I'm looking at this one going, you know, short term anything can happen, but in the long term, if this company keeps doing what it's doing financially, it's just getting stronger and stronger. And at these sort of prices, in my opinion, this is just really dirt cheap now. And hopefully for you guys that wanted a video on Huya, that summed it all up and it was useful. Hope you enjoyed it. If you could, hit the like button, and I'll see you in the next video.